Hello everyone, I'm Ted Oakley, Managing Partner here at Oxbow with our first quarter call, and like most of the quarters last year, this one started out with a lot of movement already this year. A lot of things going on in terms of Washington and Wall Street and Main Street. So we'll take a look at a few things, the economy, stocks, bonds, some things you can think about as you go forward as well. In the economy, one of the things that's happening this year is that everybody is expecting a return of a big economic year because we had such a poor year last year. You'll notice in this graph where the average for economists is something around 5.5% of GDP, and some are much higher than that as well. But why they're looking for that is they think there'll be a boom because as you come with a vaccine, people will get out more, they'll do more things. I don't know. It's hard to say about that, whether people will get back to where they were 3 years ago or not. I sort of doubt it this year, even though I do think we'll be obviously better than last year. But that's why you see this talk about the market discounting what's going to be a good year this year economically. So that's something to think about. What's driving the big year this year, the last 8 months? One of the biggest drivers has been real estate. And why is that? And I go back to this all the time, but it's the Federal Reserve. When you lower rates to the point where people can basically get money for nothing, it changes a lot of things in the business world. But one of the things it changes, if you'll see in this slide, is the amount of home you can buy 2 years ago and what you can buy now relative to the same size. And you'll see where that's up about 23 or 24%. And that's why you see this movement in housing where a lot of people are buying sight unseen, cash offers above the offering price, those sorts of things. What that has caused to is an increase in employment in the real estate area. If you look at this graph, real estate agents are back to where they almost were in 2005 and 6. Now, you're not getting the same with mortgage brokers or people in the real estate credit business, but it has had an impact on what we're seeing basically in employment overall. However, it hasn't impacted what's going on outside of building and real estate. We're seeing jobs generally well below where they were at the peak, and I don't know that we'll get to the peak again this year, but we'll see. But I sort of think that's further out in time. There's three kinds of inflation. And I wanted to talk a little bit about this today because you're going to see some things we're doing in our themes that sort of relate to this. But you'll see where you have monetary inflation, you have asset price inflation, and you have the consumer price index inflation. Now, monetary inflation has already happened. You'll see where on the blue line, okay, is the M2 money supply. Now, money supply has gone up dramatically. And it's gone up because of the Federal Reserve. Again, we've set this situation up to where there's a lot of cash chasing a lot of things. Eventually, though, if you'll notice on the orange line, eventually that has an effect on the consumer price index because you've got too much money chasing too few goods. That's monetary inflation. Second thing is in the commodity inflation. You'll see in commodity inflation where the commodity index is now, and if you'll notice on this graph, it's all the way back to where it was in 2018. So it's had a huge move, and that's all commodities, really. It goes from oil and gas all the way down to soybeans, sugar, corn. It really engulfs everything there is. And so that's another type of inflation we're starting to see. You'll notice it here too in the price of gasoline, for example. This is just one of those things that people haven't realized. But you'll notice at election time that gasoline was basically $2.09 per gallon. And I'll show you where that is really. At $2.09 a gallon election time, we're already up to $2.45 a gallon. This is basically a average retail price chart. So if you'll think about that just a minute, that's like a 20% increase, and that's basically a tax. I mean, so that's one of the things that people use the most is that. So that's just another one of those areas where we're starting to see it inflating. So where does that lead us as far as that inflation piece? And I would say this to you too, is that there's two schools of thought on this. There's a school of thought that we're not going to inflate at all because we can't. We have too much debt, and which makes a good point. And there's another school that says we have to inflate because that's the only way. The government now, with so much debt relative to GDP, that's the only way they can make it work. So what's happened is we are seeing a move in rates. You'll notice in this chart where the rates bottomed in August of 2020, and that they've gone from basically 50 basis points to 117 on a 10-year bond. Now, okay, you say, okay, that's over 100% increase, but it's still really low at that level, which tells us it probably has more room to go. And we expect that 10-year and that 30-year rate to go higher. And that's why you'll see in most of our portfolios, we haven't bought any bonds that were beyond 1, 2, or 3 years in quite some time. And that's the reason for that. Because when you do that, you're really getting very little for the money on those bonds. And to give you an idea, and people are not thinking about this, but if you'll notice in this graph, that today, the 10-year U.S. Treasury rate and the 30-year are higher than they were a year ago. And I bet nobody ever thinks about that. And all of a sudden, rates are moving up, and yet people are piling into the bond funds, not realizing that that's not the way to go right now, because that's not going to work. It hasn't worked the last month, and it probably won't work the rest of the year. So what impact does that have on the markets, okay? The impact that it has on the markets is that we're starting to see, with all this loose money that's coming in the marketplace, you'll notice in this particular S&P 500 valuation, talking about those 500 stocks, that basically, as far as percentile overpriced, overvalued, we're in an area we never have been before, even 2000. So you can stay overvalued in the market for a couple of years, but when you go into what we call the speculative overvalued stage, that means there are a lot of stupid things going on that make no sense whatsoever, and that's where we are today. You have a few things that are undervalued, but by and large, okay, it's not like everything is cheap. Most things are expensive. As an example, and I use the Goldman Sachs index here, this is an index of all the technology companies that are trading that lose money. They don't make any money. And if you'll notice, the performance of this thing really in the last 2 years has been unbelievable. Just look at it and think about that for just a second. It goes from basically 85 to 400. And these are all companies that make no money. They lose money. So if you stop and think about it just a minute, it's not making any sense. And that's okay, and it can stay that way for a while, but that's not what you should put your money down on for the long term. The other thing that's happening right now, and I've never seen this before, by the way, is that the average price to revenue for the S&P 500 companies is 3.2 times revenue, not earnings, but revenue. So if you assume about, say, a 10% profit margin on companies in the S&P 500, think about that. You're probably not going to get your money back for 20 years or longer when you're paying that kind of multiple of revenue. And it's at an all-time high, and by the way, much higher than it was back in 2000. You keep hearing about the bubble of 2000. Well, we're off the charts the last 3 years compared to that. The other thing that's happening is people are borrowing money to invest in the market. So we have this leverage at very, very high levels now. Even small investors, they're all at home doing their thing, and they'll borrow money to do this. And so what you see is margin debt at an all-time high. And you'll see from Jimmy Stack here, and it's his graph, but you'll see where at market peaks, you had margin at the certain heights, and then when it starts down, it you'll see where margin debt will come down. You'll notice it did this past year as well. So we have it at an all-time high, which means that people are really leveraged at this point, and that's having an impact as well. The other thing that's happening is, and I'm sure you're not aware of this, but the yellow line here is basically the merger acquisition deal count, the merger acquisition deal count, and you'll see it's at an all-time high. Obviously, with all this easy money, it's easy to go out and pay exorbitant prices, and hey, if I own a business, I'm going to sell it to you, and you should sell it to them, because you may not get a price like that again for a long time, because money is really, really cheap right now. But what it's done is, if you look at public companies and what they're doing with their money, and that's the blue line, we're at an all-time low of insider people. Those are corporate officers and directors, okay? All-time low of buyers. Less than 10% of insiders are buying their stock, and the rest of them are selling their stock. Sort of tells you where you are right now, and if you want to think you want to be on the same side that they're on, you're not a big buyer of a lot of these companies. So what does look good? There are two areas that really look good to us, okay? As far as they're not overpriced for what we think we'll see the next few years. One of them is pharmaceuticals. You'll find that most of the pharmaceuticals, and you'll see where we own Pfizer, Novartis, Merck, Johnson & Johnson, good companies, good dividends. You know, you're looking at those companies, some 3 to 4% dividends, and good outlook. Secondly, we like energy. And you'll notice most of the energy for us is owned in our high income portfolios, because that's where the dividends and the interest payments are. And they're really large in the energy section. But I want you to look at this graph closely. If you look at energy going all the way back for the last 12 years, energy is down 50% relative to a 200% move in the S&P 500. It's at the lowest level relative to the rest of the market in the last 60 years. Now, what does that mean? That means that everybody is basically discounting fossil fuel will never be used again. And here's the fallacy in that. Regardless of whether you like green energy or think we ought to be there, which I think most of us all want something like that, where everything wants to be clean, we're not at a stage now from just a time gap standpoint where that can work. It's impossible to get where most of these people want to be in the next 5 years, which means that with no drilling going on, energy may be one of the top performing items for the next 5 years. It would not surprise us at all. And the second thing to remember is that a lot of electrical plants run off natural gas. It's interesting to me about, hey, I love all electric, but then all of a sudden you say, well, but where does electric come from? It comes from somebody that's using natural gas to produce it. So it's an interesting setup for sure, but those two groups are interesting to us right now. So as we wrap up, I want to give you some themes here to think about today and where we are as well. Number one, bond yields are really, really low right now. So if I'm looking at a 1.5% bond, but 2% inflation, and it's a 10-year bond, I'm losing money every year. I'm going backwards all the way. My currency is being discounted all the time. So this idea that Wall Street says, okay, well, you buy 60% stocks, 40% bonds, won't work the next 5 years. And the reason is there is no 40%. If I'm only getting single digit, I'm talking about under 2% yields on corporate paper and tax-free paper, what's the 40%? You're not going to make any money. So you have to look for things that are a little differently. For us, that includes preferreds, real estate investment trusts. We own some foreign bond, different things that you normally would look for. Because if you go and I know Wall Street, I know how they're set up right now. Everybody's in this 60-40 mode, and the 40 did really well the last 2 years because rates went to zero. That will not happen going forward, and it can't because there's nowhere else for them to go. So you need to understand that that spells risk with basically no return. Secondly, stay with stocks that have low debt ratios, good liquidity, good 5-year outlook. If you look at the stocks that Chance Finucane, our Chief Investment Advisor, talks about, they're those kinds of companies. If you want to send us an email or something, ask us what kinds of companies are, we'd be glad to send it to you, but that's where we are. And then in their high income accounts, now they didn't have as good a year last year because they had real estate investment trusts and oil. But you know what? This year they may do pretty well. They've already started out on a really, really good move. And so what you're seeing there is we own real estate investment trusts, gas pipelines, we've got higher yielding common stocks. There's a lot of things in there that produce yields that are between 5, 6, 7, 8, 9%. That's what we're looking for in that type of account. And the fourth thing is keep a liquidity buffer, okay? I keep saying this to you, but when you're in a speculative, overvalued phase, you have to have an insurance policy. And the only way you have an insurance policy is to have some liquidity. You're going to have some liquidity in here. And this idea that I can't miss out, this whole thing's we're gonna have this super boom. Well, it may happen, but you know what? It can also happen when you're 75% invested instead of 100%. So look at it that way if you would. And the last thing is keep a clear mind this year. Keep your head in the game here, because that is what will make the difference over the next 1 to 2 years. So I hope you've enjoyed the quarterly call today and maybe picked up some ideas or some things that you weren't aware of. But if you have any questions or you want to know something in detail, certainly call us or send us an email at oxbowadvisors.com and we'll get back to you for sure. So with that, all the best to you, and we'll see you next quarter.